Interest rates are the cost of borrowing money. For instance, when people get a mortgage to buy a house, they pay a fee for borrowing the money, and this is calculated as a percent of, or interest rate on, the money borrowed. This line shows the effective borrowing rate that Canadians paid on all the money they borrowed over the 4-year period from 2007 to 2010. As the chart shows, interest rates go up and interest rates go down. One of the reasons for movements in these commercial interest rates is movements in the Bank of Canada's policy interest rate. A large part of the time, changes in the policy interest rate are linked to changes in commercial interest rates, but sometimes changes in the policy rate are not matched by changes in commercial interest rates, and they even diverge, as this chart shows. So why do interest rates go up and down, and what's the Bank of Canada's role in setting commercial interest rates? First, a quick reminder about what the Bank of Canada does, and about the bank's policy interest rate. The Bank of Canada is Canada's central bank. The bank is a federal agency owned by the people of Canada. The bank's 3 chief responsibilities are 1. Safeguard the value of Canada's money, 2. Ensure stability of the Canadian financial system, and 3. Provide paper banknotes. The Bank of Canada acts like a banker to the major Canadian financial institutions, and through them to the entire Canadian financial system. The bank assures that the financial system has enough money to guarantee continuing operations, and that financial markets keep operating. The policy interest rate is a target rate that the Bank of Canada uses when borrowing and lending short-term funds with the major commercial financial institutions. This short-term market is also called the overnight market, because money is typically borrowed and loaned on a one-day basis. This target rate then becomes the rate that financial institutions use when borrowing and lending among themselves in the overnight market. That's why the Bank of Canada's rate is known by 2 names, the policy interest rate and the target for the overnight rate. It is set 8 times a year by the Bank of Canada. The Bank of Canada uses the policy interest rate to keep inflation low, stable, and predictable. Significant as it is, the policy rate is not the only, or even the most important factor affecting interest rates commercial banks charge. Unlike the Bank of Canada, these financial institutions are for-profit, private sector enterprises. In the final analysis, they decide what their interest rates will be, taking into consideration a number of factors besides the Bank of Canada's policy interest rate. Consider that in order to have funds to lend to you, banks have to borrow from someone else, from their client savings accounts, on which they pay interest, and from financial markets. The cost of these funds is factored into the interest rates they charge for loans. Financial institutions also have to take into account the level of risk they face when lending money. For example, uncertainty about the future increases the further into the future one looks. Therefore, interest rates are usually higher on longer-term loans than on shorter ones. Still, other factors affect interest rates. Financial institutions also have to recover their administrative costs, and like any other business, they build in a profit margin. So while the Bank of Canada's policy interest rate is a key element influencing commercial interest rates, it is by no means the key factor. More important is how much financial institutions need to pay to borrow money in financial markets. The policy interest rate has its influence, indicating the direction in which interest rates should move to keep inflation low, stable, and predictable, but conditions in financial markets play a more important role. This explains why changes in the bank's policy rate are not always matched one-for-one by commercial banks when setting their consumer and business lending rates.